Hello everyone, good evenings. So this is Zach here from Sifu. So together with me tonight, we have Dato Yu, okay, as our special guest. Now, before we start, okay, once again, thank you for joining us in these live Facebook sections. Now, if you are here, appreciate if you can help me to click the like buttons for me. Help us to share this out. Again, a quick one. Disclaimer, this section here, we are not doing any buy and sell call. So if you want to trade any stocks based on discussion this morning, this evening over here, make sure you go on trading plan, okay? Or maybe get advice from a professional. Now, today we're going to share with you a very interesting topic, which is what I think is kind of reflect to what happens to the market nowadays. So we're going to talk about investing in volatile market using a fundamental perspective, okay, which is very important. Yes, even though we know that nowadays lots of panic in the markets, okay, but again, if we are using the right approach to tackle or maybe to aim, okay, something's looking for. I know some of you are looking for long term. I think this is a good section, okay, to help you out because I think Dato tonight, okay, today we're gonna share with us a few things that it definitely helps you, okay, in terms of value investing perspective. Okay, so with this, Dato, I'll pass the floor to you to start our section today.
Okay. Can everybody see the screen? Okay.
Yes, Dato.
Okay. Let me tell you this story. Okay. For 6 months ago, I actually started I gave a Momo account for my grandson, my 12-year-old grandson. Okay. Because I wanted him to learn fundamental investing when he was young. Okay. So I set up a Momo account for him, gave him about $2,000 and told him to go and buy 8 stocks that's familiar with. Okay. And one of the stocks he chose was Trump Media. Okay, that was in September. So I asked him why he decided to buy Trump Media since he doesn't know anything about it. And his view was that Trump is going to be the president, and as a president, he's going to ensure that his company do very well. So he's going to buy Trump Media. And from September to towards the end of December, his stocks went up by 50%. Okay, and I told him to sell off because he bought 4 shares. So I told him to sell off half of it and keep the other half because we don't know how high it will go. And lo and behold, today, Trump Media is below his purchase price. Okay, so last week, Monday, he called me and said, hey, his stocks, his whole portfolio has dropped, and should he sell? So what I will share with you tonight is basically what I told him, okay? And I hope that by the end of this presentation, you can understand my advice to him. Okay. Now, if you're going to invest in the stocks, especially if you're going to invest it from a fundamental perspective, you have to address these 3 key issues. First, of course, stocks are volatile. Secondly, if you're a fundamental investor, you are investing in a business. And even if you're investing in the business, the future is uncertain. And no matter what you may want to do with your business, you don't control the future. And then the last thing is that, as a fundamental investor, your investment is actually based on comparing the business value with the market price. And in developing the business value, there are assumptions and biases, So you need a way to address these 3 issues if you're going to invest in stocks for the long term. Now, the volatility is key. And for those of you who have seen the market up and down this past week or so, the study by Goldman Sachs shows that, there is more than a 20% drawdown every 4 years, 4 to 5 years, over the past 100 years. So the up and down is nothing unusual. And if you're going to be a long-term investor holding stocks for 8 to 9 years, You need to be able to have a way to manage this. And the other study by the CFRA says that over the past 10 years, there were 5% corrections with more than 10%. So what you're seeing today is nothing unusual. Okay, a 10% correction is happens every 1 or 2 years. Okay? So this volatility is something that we live in, and what I want to share with you is what I've developed over the past 20 odd years to handle the volatility, to handle the uncertainty about the future, and what to do, about your assumptions and biases. Okay. Now, conceptually, okay, if I classify them into three, okay, the first way to handle volatility is to have a very good asset allocation plan, what I call my 3-bucket asset allocation plan. The way to handle the uncertainty is to make sure that you have a stock portfolio. Okay? And finally, if you are going to value stocks, then you do so with a margin of safety. So what I'd like to spend the next 20 minutes or so is to give you a basis, okay, to address each of them. Okay? So let's talk about asset allocation. Now, the way to look at asset allocation is to look at the net worth. Okay, so basically, take all your assets minus your liability, and that's your net worth, and divide them into what I call 3 buckets. So the first bucket is the liquid assets. This is basically cash. The second bucket is what I call safe assets. These are assets where the principal is protected. So you get low returns, but you won't go to zero. And then the risky assets are where you put the balance. And here are your stocks, your properties, your crypto, your commodities, whatever you want to do. Okay. And this is a very simple asset allocation plan, which I think is much better than all those that you've seen in terms of the 60-40 and all the other things that people talk about. Okay. Now, in the Malaysian context, okay, what falls into liquid assets are cash, your fixed deposit with the bank, your safe assets. I will classify your EPF savings as safe. Okay, it won't go to zero. If you had a chance to buy the Amanah Saham, okay, the ASM schemes are considered safe assets because it's unlikely to go to zero as well. And the risky assets are the balance. Okay, so I put stocks here, I put properties, okay, especially those additional properties that you want to buy, your investment properties, things like your crypto and so on. So this is how I divide my net asset into 3. And the logic is as follows now. Stocks are volatile. Okay, so you want liquid assets so that in case you have emergency, you are not forced to sell the stocks at the wrong time. Okay, so the liquid assets protect you from what I call the volatility risk. Okay. The safe assets are the one that gives you the safety net in case you lose all in your risky assets. Okay. In theory, of course, you should not lose all your stocks. Okay, but in case you lose everything, okay, you then have a safety net. Okay, that you still have some assets left. You're not going to go bankrupt. Okay, and then your risky assets are basically the ones that is going to drive the returns. So think of your asset allocation in this manner: liquid assets to control volatility, safe assets to ensure that if you're unlucky and you really lose all in your risky assets, you still have a fallback. Okay, and think of the risky assets as the way to drive better returns. Now, the allocation plan, of course, would depend on your risk tolerance and so on. But I like to think of it in terms of annual expenditure. So for example, I have about 1 to 2 years of my annual expenditure in terms of liquid assets. So if you have friends or you have parents or you've got a way to help you go through emergencies, then you can reduce your liquid asset exposure. But if you don't have anybody else to rely on, then you need to have at least 1 or 2 years of your annual expenditure tied up in liquid assets, because stocks can go down for a long time. Okay, and you don't want to be caught in a situation where you sell at a loss just to cover unforeseen emergencies. Okay, so what are unforeseen emergencies? Unforeseen medical expenses. You get retrenched. Things are things that you don't normally expect. Now, the safe assets, again, that depends on your risk tolerance, and that depends on your total amount of net worth. I have about 10 years of my annual expenditure tied up in the safe assets. Okay, and everything else I dump into risky assets. In my case, I have a balance, half in stocks, half in properties, and a bit, maybe about 5% in crypto. Okay. Now, each of you, I would suggest that irrespective of your net worth and so on, okay, or irrespective of how old you are, think of your asset allocation in this manner, so that when you invest in stocks, you end up maybe 20-30% of your net assets in the risky assets. You make sure that you always have a safe assets. Okay. Now, that's what I call a practical asset allocation plan that is geared towards a stock investing framework, because stocks, unlike properties, are risky. Okay, is volatile, and you have a way to distribute your net worth in a way that protects volatility and protects the risk. Okay, so the challenge, of course, is that if you are starting out and you don't have much of a net worth, then I would suggest that you still need something for your liquid assets, but then you may want to reduce the allocation for the safe assets and a bit more on your risky assets. Okay, because if you are in the 20s and 30s, you probably have a longer life to recover whatever you have lost. Whereas if you're a 70 or 80, if it goes down and you lose a lot, you don't have much time to recover. So think of this as the most important, okay, the 3-bucket allocation as the most important way to distribute your money if you want to invest in stocks for the long term. Okay. Now, the second thing is that how do you manage uncertainty? Okay. Unfortunately, we all don't have a crystal ball, and I would suggest that rather than try to forecast the economy, forecast the political situation, and so on, you diversify and invest in a stock portfolio. Never buy only 1 or 2 stocks. Have a diversified portfolio. And let me share with you the logic behind why diversification works. So imagine that you have 100 ringgit, okay, and you're going to invest it in the stocks where you can either win 10% or you lose 10%. So that if you win, you get 110. If you lose, you get 90. Now, instead of investing in one stock, you divide your $100 into 2, okay, into stock A and B, where each has the same win or loss, okay, so that if the stocks are positive correlated, that means if A goes up, B goes up. If A goes down, B goes down. You will find out that when A goes up, B goes up, your total is about the same as if you only invest in one stock. Your loss is about the same when you only invest in one stock. Now, this is a situation where imagine that when you buy, for example, you want to invest in stock market and you buy 2 property companies. Okay, now the 2 property counters are moving are driven by the same socio-economic forces. So they are what I call positive correlated. So if stock goes up, stock A goes up, likely the stock B goes up. Now, if you do that, you don't have what I call a diversified portfolio. A diversified portfolio is one where the stocks are not correlated. So for example, if you have A and B, which are not correlated, that means when A makes money, B loses, this is 100% negative correlate. Or when A loses money, B makes money, okay? You'll find out that if you have 100% negatively correlation, okay, no matter what happens, you still make 100 each, okay, irrespective of how the correlation is. And when you compare the 100 with the correlation and you compare the 100 with the one stock, you find out that because you have a diversified portfolio, you are going to lose less, okay, than when you have only one stocks, okay? But of course, you make less, okay? So there's always a trade-off between risk and return, okay? And that's basically the idea behind the stock portfolio, that if you're going to have a portfolio of stocks, you want the stocks, you don't want the stocks to be correlated. You want them to be moving at different correlations so that when some win, some loses, so that overall you are better off. So that's the logic behind the modern portfolio theory, except that the modern portfolio theory, of course, is much more mathematical, okay? And I don't really follow the modern portfolio theory because my stocks are not selected based on the portfolio theory. Rather, I build up my portfolio based on individual stock picking process. So what I've done is that instead of following the portfolio theory 100%, I adapt the concept that I want a diversified stocks so that when I build up my portfolio, I try to make sure it's diversified. But more important, studies have shown that if you have a diversified stocks, the benefit of diversification becomes marginal after 30 to 60 stocks. So what I try to do is I try to target about 40 stocks, because the more you have, the lower your returns. Of course, the more you have, the lower the risk. So I think that 30 to 40, gives me the sweet spot in terms of balancing the returns and the risk. So if you are a stock picker like me and you want to have a diversified portfolio, what I do is then I look at my portfolio based on a number of what I call characteristics. So for example, I want to make sure that if I have 40 stocks, they all come from different sectors. Okay, so owning 40, for example, property companies is not diversified, but having one property company, one shipping company, one oil and gas, and so on, if they are different sectors, I'm confident that they are diversified. At the same time, I look across regions. So instead of just focusing on Bursa Malaysia, I have some Singapore stocks, I have US stocks. And at the same time, I also look at size. That means I will have a range of market cap. Some are big, some are small. Okay. And finally, in the context of the fundamental mapper, I make sure that I have stocks in different categories. And what I then have is a rule of thumb to say that if I have 40 stocks and I have 100,000 invested, okay, or 10 million invested in a stock, a single stock should not be more than 10% of the portfolio. This to make sure that I'm not overly concentrated. And then within each industry, for example, I try to make sure that I don't have more than 30% of the stocks within one sector. So for example, I have a very strong exposure to property because of my background, but I try to limit it to about 25% so that the property sector is about 25%. And what I do is then I dice and analyze my portfolio to make sure that they are distributed differently by sectors, by size, by regions, and by category. So it is a simple rule of thumb without mathematics to make sure that I have a uncorrelated portfolio. Now, the category that I talk about is because of the fundamental mapper. That's the app that we have developed that classify businesses based on their business performance and investment risk. And what they do is then they classify and group the companies into 4 different quadrants, based on the investment risk and the business prospects. And what I try to do is that, of course, if you've been following my talk, you will know that we should have most of the stocks in the gold mine sector. But what I try to do is I try to have some stocks in different quadrants because we don't know how the future turn out. The bad stocks can become good, the good stocks can become bad because business performance changes. So I try to also have a mix of stocks with some from different quadrants as part of my portfolio diversification program. So that's basically what I do. Okay. So the key message is that you have to live with the uncertainty. Okay. I mean, we all run businesses. We all like to think that we can project our business performance 2-3 years down the road. I would tell you that, when I was running iBahad, we make 5-year plans. Okay. And if we, at the end of 5 years, we hit 70 to 8% of what we set out to do 5 years ago, we all laugh. Okay. It's a tough trying to forecast the market. Okay. And not just because of the economic situation, but because there are political changes, there are new entrants and so on. So even with the best intention and so on, it is very hard, as an insider, to even tell you where the business will be in 10 years' time. So if you're an investor investing from outside, you even have less hope in trying to say where the business will be, in 10 years' time. So the best advice is have a portfolio of stocks. Okay, have at least 20 to 30 stocks. If you want to be a concentrated one, I would advise to have at least 30 to 40, and have a simple rule of thumb to make sure that the stocks in your portfolio are not correlated. Now, the final one, of course, is the margin of safety. Okay, and this goes back to the fundamental of investing, value investing, where you buy when your business value is more than the market price, and you sell when the market price far exceeds your business value. And the heart of it is, of course, valuing the company. And unfortunately, all valuations are based on assumptions. Okay, it is subjective because you have to guess where the business is going to go over the next 10 years. And even if you guess correctly, your biases is going to come into your valuation. So the way people like Warren Buffett and even Professor Damodaran do is then say, when you value a company, you try to do it with a margin of safety. And the margin of safety is an engineering concept. Okay, and what it means is that if you are building a bridge, for example, okay, and your bridge is going to be used for 2 cars, okay, and what you do is when you design the bridge, you design it to hold more than 2 cars. So in this example here, you design it to hold 4 cars. Okay, so you then have a margin of safety in your design, so that in case you make some error in your design, or the contractor makes some construction error, or some big truck comes in, the bridge does not collapse. And that concept was adopted by Benjamin Graham when he developed the value investing theory, 50, 60 years ago, to say that when you value a company, okay, and your valuation say that the company is worth $100 and the market price is $100, you do not buy because you don't have a margin of safety. But if you value a company and it's $100 and the market price is $50, you then have 100% margin of safety, okay? And he says to you, that's a buy, okay? So everybody who does valuation, okay, adopted this idea because this will ensure that if you make mistakes in your assumptions or you make some careless mistake and so on, you still have some margin of safety to cover for all of this. So to give you an example of the margin of safety, let me go back to the fundamental mapper. So that when we design the fundamental mapper, okay, you find out that we have a horizontal line, okay, so that the top is which divides the investment risk. So the top above this horizontal line is risky, below is not risky. And then we have a vertical line, which means on the right, it is a strong business. On the left, it is a not so strong business. Now, what we did in our design was that we did not set the horizontal line at 0. We set the horizontal line in such a way that when it is at the horizontal line, there's actually a 30% margin of safety comparing the market price and the business value. So we built in the margin safety, okay, in the risk axis. And we have also built in a margin of safety in the business axis as well, so that when we say it is a good company, it's actually 30% better than the average. Okay, so the vertical line does not mean average; it is actually mean better than the average. So we adopted this concept in the fundamental mapper just to make sure that if you're a layman and it falls and you look and say, hey, this is a strong company and there is a low investment risk, we actually have already built in the margin of safety from both the fundamental perspective as well as the valuation perspective. Now, the other thing that we have done in margin of safety is that because all valuations are based on assumptions, there are several ways in which you can value a company. Okay, I won't go details into the valuation type, but what I've seen here is that I use a number of ways to value companies. Each one has its own assumptions and bias and so on. And what I try to do is I then try to triangulate a value, okay, based on different valuation approaches, so that if all of them point in the same direction, okay, if all of them says that they are overvalued, then I know it is overvalued. If all of them says that, oh, it is undervalued, I'm very confident it's undervalued. If it is a mixture of them, then I don't buy, I don't sell, because we don't know enough. Okay, so that's basically what I do. So to sum it up, then, okay, all I'm saying is that if you're going to invest in the long term as a fundamental investor, you need to address these three issues. Stocks will always be volatile. You always have to contend with uncertainty. And no matter how clever you are, okay, you will always have contend with assumptions and biases when you value the company. So what I hope to have given you is a framework to think about how to address these three issues. Okay, so in terms of volatility, use an asset allocation process that actually tackles volatility. Okay, when you invest in stocks, don't buy one stocks. Okay, have a portfolio. I would suggest that at least minimum 25 to 30 stocks. And if you are going to do valuation, look for a margin of safety. Even if you're not valuing the stocks yourself, look at 3 or 4 people's valuation and then make sure that if all of them are pointing to the same direction, then you are more confident about the valuation. Now, having said that, we still have to come back to the question, okay, which my grandson asked, should I get out? Okay, the market is down. Should I sell all my stocks and hold cash? Or, if you read Warren Buffett and you read all the articles about value investing, the advice, of course, is that you don't panic when the market is down. Okay, easier said than done. Okay, and the only reason why you should not panic and you don't panic is because when you bought the stocks that time, you bought it at a time when the market price was less than the business value. To give an example, if you estimated that your business value was worth $100 per share and the market price then was $70 a share, you would have bought it with a 20 to 30% margin of safety. So if today the market price went down from $70 to $50, your business value is still higher than the market price. So if you have a basis for your purchase, then you will know that don't sell because the business value is still intact. So I told my grandson, because he bought Intel, he bought Google, Microsoft, okay, Pepsi Cola, and Disney, okay. I told him these are all good businesses, okay. The market price may have come down, but I think the business value is still intact. Unfortunately, the market volatility, I think that's the word I use, is not just due to market sentiments. Because of the tariff plans, okay, I use the word the tariff plans. Some businesses are going to be affected by the tariffs, okay, and for those businesses where the business value are going to be affected by the tariff, I think the business value would be affected and go down. So if you have bought companies, for example, those importing wine, for one or better word, and the wine tariff actually goes through, then you're going to have a lot of trouble, okay, for the US companies who imported wine, because I think their business is going to be affected if the tariff actually goes through and sustained. Okay, but if you have bought, for example, US steelmakers, okay, or US aluminum companies, I think that the tariff is going to protect them and the business value is going to be better. Okay, so that even if the market price today has not gone down, I suspect that their business value would go above beyond the market price in a couple of years' time. And you may think then that there's a business opportunity. So the question then is, whether you buy or sell then depends on your particular business. So I told my grandson, I'm sorry, your Trump media, you went in on speculation. I have no idea how Trump media will perform because today it is below his purchase price. Luckily, he sold off half of it, so he made some money. Okay, but unless Trump has some other ideas that he wants to inject into Trump media and make the business value higher, it is pure speculation. And unfortunately, I have no idea what to do with Trump media. Okay, so to come back to the fundamental mapper. Okay, now I've already told you how the fundamental mapper is designed, and for those of you who are looking at the fundamental mapper, if today you have stocks that fall into this white zone, okay, that means more than halfway above the risk axis, okay, I would think that you should rethink about your stock position because it is high risk and poor business performance. You should then have a quick relook, okay. This is, I would imagine, the spot where if you have stocks here, potential stocks to sell. Okay, so that's looking at it from the business perspective and the investment risk perspective, vis-a-vis of what I know, in the design of the fundamental mapper. So basically, that's all I'm going to say. I hope that I've given you a framework that if you want to invest as a long-term investor, you have a way to think about how to allocate your money and how much to set aside for stocks. I've given you a way to think about how many stocks you should hold, and I hope that I've given you a framework to say that to think about whether to buy or sell stocks. So for those of you who have not signed up to the Fundamental Mapper, it is a very useful tool, especially for those of you who don't have the time to do all the analysis. We have done it for you. So please download the app if you want to have an easy way to invest as a fundamental investor. So that's, ladies and gentlemen, is basically my key message. If you want to be a fundamental investor, learn to live with volatility. Okay, have a way to deal with the uncertainty, and whatever you do, buy and sell with a margin of safety. So if the stock price is $100 and your valuation is $100, you don't buy. Okay, if your valuation is $100 and the stock price is $70, yeah, okay, I think you have a margin of safety. If your stock price is $100 and the market price is $200, I would sell. Okay. So that's all I have. I'll be happy to answer any questions you have.
Okay, thank you, Dato, for your sharing over here. So for those that who are with us, okay, any questions you have for Dato, you can actually comment below. Dato happy to answer some questions. I think just now Dato also shared with us some of the very useful information, especially the framework that he showed with us. I think, yeah, as an investor, we have to so-called bear through these market volatilities, which is currently we are facing right now.
One of the challenges, okay, with fundamental investing is that people don't talk very much about the risk protection, unlike technical and stock trading. Because when you do a stock trading, your stop loss is your risk control. Okay, and then if you look at money management, okay, and the theory is that you should not invest more than 5% of your fund in one stock. You already built that risk management into a trading process. Whereas when I started fundamental investing, I couldn't find any such advice, and I sort of had to copy a lot of it from the trading ideas. Okay.
So Dato, which means that currently you're also practicing diversify your portfolio, 5% stocks.
Yeah, because we are. Okay. People like Warren Buffett always say that you hold concentrated. Okay. Now, unless you have Warren Buffett skills, because Warren Buffett always talk of holding 10 to 15 stocks. Okay. Unless you have his stock picking skills, which I don't have, I dare not hold 10, 15 stocks. So I hold about 30 to, I try to keep it below 40. So it's average about 30 to 35 that I hold. Okay.
Okay. But Dato, that one is Bursa only or including US market?
No, that means basically because at the moment about 20% of my stocks are US stocks. So I hold it across regions. Then I have some in US as well. That's right, in Singapore as well. So I have across regions, but historically a big part of it is Bursa because I understand the Malaysian market better. So I hope that I have a safety net because of that.
Okay, understand, Dato. Okay, any questions for Dato? If not, probably we'll end our sections for tonight over here. So Dato, we'll have another section in 2 weeks from now.
Yep. Okay. We'll try to see whether we have it on Wednesday because Friday is going to be very close to Raya.
Oh yeah, the following 2 weeks is going close to Raya already. Probably we'll change to.
I think on Friday everybody is going to go off already.
Yeah,
so we try to see whether we push it to Wednesday now.
Okay, can. So for those that who are joining, for those that who are here, okay, make sure you follow us our Telegram. So we will actually post our upcoming event together with Dato into our Telegram, and we give everyone an update. So with this, once again, thank you to Dato. Thank you for those that who joining us. We will see you in the next sections.
Okay. Good night.